Hello, I'm Carolina Jolly, an analyst here at Gabelli Funds. Today I'd like to talk about the company Monro. 33 million shares at $29 for a market cap of $1 billion, net debt of $330 million. Monro operates 1,300 service and tire repair shops under the names of Monro, Tire Choice, and Mr. Tire. Traditional maintenance services account for 50% of revenue, and tire revenues account for the other 50%. Year to date, Monro's stock price has come down from $45 to $29 as the company has struggled to push through higher costs, technician wages, and more recently, the company saw customers defer higher ticket items such as tires. The stock now trades under 8 times consensus EBITDA estimates. This is well below its 3-year historical average of 12 to 13 times and below multiples for previously announced private transactions such as Town Fair, Mavis, and Les Schwab tires, which were estimated to be completed at 12 to 16 times EBITDA. Given where the stock is trading, Monro could be a potential longer-term acquisition target, as scale is increasingly important in this historically fragmented industry. Industry consolidation is occurring as companies drive margin benefits via purchasing power and investing in technology that drives customer service and optionality. Specific to demand trends, in the company's most recent quarter, Monro described customer trade down in higher ticket, higher margin services. While we believe these trends will continue into next quarter, we also note that this is deferred maintenance. Historically and logistically, deferred maintenance needs to be completed as owners need to get to work, make an income, take their children to school, and the list goes on. Oftentimes, wear and tear actually worsens after deferment. Looking back to the 10K of March 2009, the company generated a 5% comp and noted that despite some deferment, the company believed consumers were maintaining their vehicles over buying new due to the weak environment. Thus, Monro and the auto repair market historically experienced less volatility and positive comps in a recessionary market. Despite some trade down, there are tailwinds for Monro's customer, which is an owner of a 6-plus-year-old vehicle. These include miles driven, which are up 2% year to date, as people have to go to work and make an income, and a customer who maintains their vehicle over buying. Used vehicle prices are still up 40% over 2019 levels, along with higher interest rates. Specific to margin, the automotive repair industry faced significant cost inflation in both underlying product costs and technician wages, with auto parts distributors noting over 15% price increases over the last 2 years. In fiscal year 2023, Monro stated that they would not pass along all of the additional costs to customers, as the company wanted to maintain these customers over the long term. Partially in response to this decision, margins contracted by 300 basis points over the last 2 years and nearly 600 basis points from the start of COVID. Given commentary from the tire industry, such as Goodyear Tire, that tires have been overstocked, we believe that at least 50% of Monro's product costs will see moderating cost pressures in the near term. Going forward, execution improvements, inflation moderation, and positive comp trends should drive both margin expansion and EPS growth. Thank you.